When the yield curve is inverted, the long-term rate is lower than the short-term rate. Now that makes no sense in terms of risk, but it makes a lot of sense if you expect a recession. Because if you take a 4.5% coupon, 4.5% yield to maturity on a 10-year treasury note.
Each financial crisis has been more dangerous than the last. In 1998, we faced a crisis, then again in 2008, and now we might be approaching a point where the next crisis could be too big for the Federal Reserve to handle. Jim Rickards thinks we are uncomfortably close to that, though it's hard to say exactly how close because the financial system is complex. While we can predict the magnitude of a crisis in such a system, it's nearly impossible to get the timing right. But based on recent history, it's clear we're in a precarious position. Looking back at 1998, we came within hours of shutting down global markets. The crisis started on August 17, 1998, when Russia defaulted on its external debt and the ruble was massively devalued. That set off a global liquidity crisis. It spread rapidly and ended up at long-term capital management, where we had $1.4 trillion in derivatives. People often think our firm lost a lot of money in Russia. We did lose about $100 million there, but the bigger problem was the $4 billion we lost on everything else because, in a liquidity crisis, people sell off all assets, not just the troubled ones. Spreads widen, collateral disappears, margin calls increase, and people are forced out of their positions. This is how a global financial crisis unfolds. The Federal Reserve stepped in with a $4 billion cash injection, and Alan Greenspan made 2 rate cuts, one on an emergency basis, to stabilize things. We got through that, but it was close, within hours of shutting down every market worldwide. Then in 2008, we saw a similar situation. Most people remember September 15, 2008, when Lehman Brothers collapsed. What many don't realize is that Morgan Stanley and Goldman Sachs were days away from failing too. John Mack, who was CEO of Morgan Stanley at the time, said that while Lehman was begging for help, Morgan Stanley had its own survival to worry about. The Federal Reserve once again stepped in, cutting rates and bailing out the system. The dominoes were falling, and without the Fed, they would have kept falling. Each crisis gets more dangerous, and each bailout gets bigger.
It's lower than the overnight rate is like 5.5%, and the 10-year note was 4.5%. So why would you take a lower rate on a much longer maturity? The answer is that overnight rate is an overnight rate. It could change quickly, and I'm only locked it in for a month or 6 months or whatever. But that 4.5% rate could look really sweet in a world of sub 2% interest rates. So that's a signal that a recession is coming, because that's why you would take the lower rate, because in a world of lower rates, interest rates go way down. Now what's happened literally just in the last couple of weeks is the yield curves are starting to uninvert. That is and it's not because the longer term rates are going up. They're not. It's because the short term rates are dropping really fast. So the yield curve is starting to assume a more normal upward sloping curve. What does that mean? That means we're in the recession. That means that inflation is not a concern at all, and rates are trending down. Car sales are dropping. Housing is unaffordable. The unemployment report's kind of a joke, and what I mean by that is, as you know, they have 2 reports: the employer survey and the household survey. One, you call employers and say, how many people did you hire or fire? The other ones you call household and say, did you get a job or lose a job? In theory, they should be the same. Of course, they never are, because the survey is never 100%, but they should be close. They're not close. They've diverged to a significant extent. The employer survey is showing much higher job creation, whereas the household survey in some recent months has shown huge job losses.
So what can you do? You need to hold assets that can withstand a global liquidity crisis. Land, real estate, gold, silver, fine art, natural resources. These are safer investments. Look at the art market. Andy Warhol's Marilyn Monroe painting is now valued at $200 million, and you could have bought it for $50,000 in the 1970s. While art is a bit more specialized, natural resources like water and energy are solid bets. If you want to be in stocks, focus on companies linked to natural resources like ExxonMobil or Chevron. But a regular stock portfolio isn't going to protect you. Banks and money market funds will be in trouble during a liquidity crisis. It's also important to note that the dollar has been a kind of cryptocurrency since 1979. That was the last year paper treasury notes were issued, the kind where you'd peel off a coupon and take it to the bank. Since then, all dollar transactions have been digitized and encrypted. This shift in the nature of currency is something to keep in mind, especially when we look at how economic sanctions are being used today. Sanctions can be powerful, but if they're used too broadly, they lose their effect. There's also a risk of overusing sanctions. For instance, we've never frozen a central bank's assets before, but we did with Russia. We've never kicked an entire country out of the SWIFT banking system, except Iran, but that was a smaller case. But now we've done that with Russia too. When this happens, countries start looking for alternatives. For example, Saudi Arabia is considering new payment systems and currencies. If you're a Saudi prince with assets around the world, yachts, houses, jets, you're now wondering if those could be seized like the assets of Russian oligarchs.
The other interesting angle to this is that for a long time, Saudi Arabia has teased that it could perhaps start selling its oil in yuan to those Chinese buyers. Do you see that as a material risk? It's something that often comes up in conversation during times of tension between the US and Saudi Arabia. Are we going to see oil priced in yuan as this strategic pivot across the region and China's push into the American sphere of influence continues?
I think it's already happening, and I wrote about it a lot in my book, De-dollarization. I think that this trend is already beginning. There's no reason why two countries that already have vast exposure to the US dollar should maintain their trade in a third-party currency. The Saudis have a lot to buy from China. China has a lot to buy from Saudi Arabia. Why should they transact in a third-party currency and incur all of these exchange rate costs and so forth? It's much more natural for them to trade in their own currencies or engage in barter deals so that Chinese send their infrastructure companies to Saudi Arabia, and in exchange Saudi Arabia sends oil. So there are a lot of models that could apply here. But I certainly think that even though nobody wants to make a big noise about the de-dollarization issue because that's such a sensitive issue for the United States, I think that this is sort of in the subtext of a lot of what's going on here.
We've also seen this kind of financial control domestically, like in Canada, when Deputy Prime Minister Chrystia Freeland froze the bank accounts and crypto wallets of the truckers involved in the protests. Canada even criminalized support for the protests. This kind of control isn't just limited to oligarchs, it's affecting everyday people. So the US and Canada, two of the largest economies in the world, have shown they're willing to freeze accounts when they see fit. While people may argue it's for good reasons, like Russia's invasion of Ukraine, if you're a wealthy individual in China or Saudi Arabia, this is a big concern. Russia and China have been preparing for this shift. Back in 2009, we warned the Pentagon that countries like these would increase their gold reserves, and that's exactly what they've done. Russia has grown its reserves from 600 tons to 2,300 tons, and China has done the same, now holding around 2,000 tons, though they might have even more off the books. People speculate about the Chinese yuan becoming a global reserve currency, but that's unlikely for several reasons.
A crucial initiative for this is supplanting the global role the US dollar currently plays. De-dollarization, he calls it. Most trade is denominated in dollars, and most reserves in central banks around the world are dollars. The greenback is also the primary reserve asset for many international agencies. So eyebrows have risen with special arrangements China has made using the yuan. In a recent deal, China's state-owned China National Offshore Oil Corporation is paying yuan to France's giant Total Energies for liquefied natural gas. China and Saudi Arabia are closing in on an agreement whereby China would pay for oil in yuan rather than dollars. China's pressuring other parties when it can to use the yuan. China is the biggest direct foreign investor in Africa and is now a major investor in other parts of the world. It is rivaling the IMF and the World Bank in loans to developing countries. Now, many politicians, pundits, and policymakers question whether the dollar's status as the world's reserve currency can be maintained. Our economy has floundered for most of this century, with growth rates far below our historic average. Our public sector debts are ballooning as wasteful spending remains unchecked. Our central bank is dangerously clueless about inflation. So is the dollar doomed? Will the yuan become the preferred international currency? The answer is no. Countries like Saudi Arabia are harboring deep diplomatic grievances and concerns about our blundering foreign policy, and it will do yuan-denominated deals to express dissatisfaction with Washington.
When people talk about reserve currency, they don't mean that central banks like the People's Bank of China have stacks of US dollars lying around. What they're really talking about are dollar-denominated assets, like treasury bonds and notes. For instance, China holds US treasuries, not literal cash. So when some suggest that the Chinese yuan could replace the US dollar as the global reserve currency, it's worth asking, where's the yuan bond market? The truth is, it barely exists. The US bond market, on the other hand, is huge and highly liquid. It has primary dealers, auction systems, settlement mechanisms, repo markets, and most importantly, a rule of law that investors trust. If you buy US treasuries and something goes wrong, you can sue. Good luck doing that in China. Their lack of legal transparency, combined with a non-existent bond market, are major reasons why the yuan or ruble won't replace the US dollar as the reserve currency anytime soon. However, a new currency system could emerge. In my hypothetical scenario, this new currency would be backed by gold and structured under Swiss banking and UK law, ensuring trust and transparency. You could deposit your own gold to get some of this new currency, or you could earn it through trade surpluses. Such a system would be designed to instill confidence, something critical in the international finance. But without an established bond market, China's yuan or Russia's ruble won't challenge the US dollar. Despite that, the bigger issue lies with the US itself. There's growing concern about a collapse in confidence in the US dollar and, by extension, the entire international monetary system, which is built on the dollar. If the dollar fails, the system goes with it. This isn't a far-fetched idea. The international monetary system has collapsed 3 times in the last century, in 1914, 1939, and 1971. So another collapse, which would be the 4th in 100 years, isn't entirely out of the question.
The supply chain was breaking down before COVID. Now, of course, COVID made it worse, yes. And the war in Ukraine made it worse, yes. But this really started with Trump's trade war in 2018. That, like I said, there's a thread that runs through all these things. So not to throw out my hands, I'm not going to do that. But when you ask me that, I'm thinking, well, you want to talk about China, Ukraine, supply chain, Biden, they're all a big deal. In terms of tragedy, probably the war in Ukraine is the most important because it's highly, highly significant economically and strategically. But of course, it's a human tragedy going with it. If Chinese real estate implodes, okay, there's some hardship here and there, but it's not like people being killed or maimed or forced into refugee status. And that is part of what's going on in Ukraine. So that's probably the biggest single one, but I wouldn't miss the fact that all these things are going on at once. The number one question, of course, everyone's concerned about inflation, but there's a big backstory there. But I always say, when it comes to your own money, everybody has a PhD in economics. You don't need Larry Summers to tell you what's going on with your budget and your ability to feed your family or keep a roof over your head. So people get inflation. One of the reasons it's so politically toxic is because it's unavoidable. You can't fudge it. You can't spin it. It's like, hey, if I used to fill up my Ford F-150 truck for $50 and now it's $125, A, you get it. It's right in your face. And B, that's $75 that you don't have to take your spouse out to dinner, buy a new jacket or whatever. So there's kind of demand destruction at the same time you're spending more money on the one thing you can't do without. So people get it. But then from there, the question I get the most is, hey, Jim, is this going to cause a recession? Are we going to have a recession? And as recently as a few months ago, I would say, yeah, I think so. You can see it coming late this year, early next year.
When this happens, it's not the end of the world. The major financial and trading powers would gather, much like they did at Bretton Woods, and create a new set of rules to govern the system. We can already see the cracks forming, so it's worth considering what a future international monetary system might look like after such a collapse. There are 4 scenarios to think about: multiple reserve currencies, SDRs, special drawing rights, a return to the gold standard, or collapse followed by something worse. The first scenario, multiple reserve currencies, could happen as the US dollar continues to lose its dominance. In 2000, about 70% of global reserves were held in dollars. Today, it's around 60%, and it could drop below 50%. In such a world, the euro, Australian dollar, and Canadian dollar would take on larger roles. But this kumbaya approach, where everyone gets along and shares the reserve currency spotlight, is unstable. Without a single anchor like the dollar or gold, multiple central banks could behave irresponsibly, exacerbating currency wars rather than solving them. The second option, SDRs, is the preferred solution of the global elites: finance ministers, central bankers, and policymakers. SDRs are a form of world money created by the IMF. It's like the Fed printing dollars, but on a global scale. The IMF can print SDRs whenever it wants and use them to reflate and reliquefy the global economy. In fact, the IMF has a 10-year plan to make SDRs the global reserve currency. This isn't a secret. You can find it on their website. An example of how SDRs are already in play. In 2009, Congress gave the U.S. Treasury authority to provide $100 billion to the IMF. What did the IMF do with that money? Around 91% of it went to bail out Europe and Mexico, while only 9% went to developing countries. So while Americans were told this money was meant to help emerging markets, most of it ended up in Europe. The third possibility is a return to the gold standard. Any gold standard ties paper money to physical gold, but there are important decisions to make. First, how do you define money? There are different technical definitions like M0, M1, and M2, and you'd have to choose one. Second, what reserve ratio should be used? Some argue for 100% backing, but historically, countries like England and the US have run successful gold standards with much lower backing, 20% and 40% respectively. Lastly, which nations would participate? The US could go it alone, but that would be a mistake. If only the dollar is backed by gold, every other currency would become worthless, creating extreme deflation and repeating the blunder Winston Churchill made in 1925. If a new gold-backed system were to emerge, the US and Europe would have a strong position because they still hold the majority of the world's gold, about 18,000 tons combined. China, which is notoriously secretive about its gold reserves, likely has more than the 1,000 tons they claim, probably closer to 4,000 tons. This gives China a significant seat at the table in any future international monetary negotiations.
Hi, I'm Steve Clemens, and I have a question. The West likes to dismiss the BRICS alliance as a political sideshow, but is it starting to crack the US-led global order? Let's get to the bottom line. Next week, the group of countries known as the BRICS meet in Russia for its annual summit. After the Alliance of Emerging Economies expanded last year, these 9 countries now represent a bigger slice of global wealth than the G7, the main economic group of the United States and its junior partners. Population-wise, BRICS represents about 5 times more people around the world than these G7 nations, and it literally has 40 countries knocking on its door to join. But what power does it really have? And can the BRICS pose a challenge to America's grip on global dominance and the global economy, even if it wanted to? Today we're talking with Richard Wolff, Professor Emeritus of Economics at the University of Massachusetts and author of more than a dozen books on the global economy, including Democracy at Work, A Cure for Capitalism. Richard, it's a real honor to have you on the show today. And I want to just ask you, like, point blank, BRICS, is it a real new thing that's going to challenge the American global order, or is it still an illusion?
Well, the short answer to your question is it's a real thing, not an illusion. It's already challenged the order that was dominated by the United States, and it promises to continue to do so. It certainly is as we are speaking. It is only wishful thinking on the part of the major countries of what we used to call the collective West, or maybe should still call it, It's a self-delusion on the part of the West to minimize it, to brush it off.
So whether it's a shift to multiple reserve currencies, SDRs, or a new gold-backed system, the current international monetary order seems fragile. And while we can't predict exactly what comes next, history suggests that when systems collapse, the world's financial powers will gather, renegotiate, and set new rules to govern the future. How do you think this will turn out in the future? Let us know in the comments below.